studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
Let's begin with the most important concept in shareholder benefits. A corporation is a completely separate legal entity from its shareholder. Even if one person owns 100% of the company, the corporation legally owns its own cash, bank accounts, vehicles, equipment, and all other business assets. This means the money inside the corporation does not automatically belong to the shareholder. The shareholder cannot simply treat the company as a personal bank account or freely use corporate property for personal purposes. So, how can an owner legally access corporate money? There are three common and CRA-accepted methods. First, through salary or wages, which are reported on a T4 slip as employment income. Second, through dividends, which are distributions of the corporation's after-tax profits and are reported on a T5 slip. And third, through reimbursement of legitimate business expenses. If a shareholder pays for a genuine business expense personally, the corporation can reimburse that amount without creating taxable income, provided proper documentation is maintained. The key takeaway is simple. Corporate money belongs to the corporation, not the shareholder. Any money taken out should flow through proper tax channels to ensure it is reported correctly and to avoid future tax issues. When a shareholder uses corporate resources for personal purposes, that's where shareholder benefit problems usually begin. Remember, the corporation is a separate legal entity. So whenever corporate money or assets are used to provide a personal advantage to the shareholder, the Canada Revenue Agency may consider that advantage to be a taxable shareholder benefit. Some common examples include purchasing a personal vehicle through the corporation, paying for home renovations, allowing family members to use a company-owned cottage, paying personal expenses with corporate funds, or simply withdrawing cash without proper tax treatment. These transactions are closely examined because they provide a personal benefit rather than a business benefit. The safest ways to access corporate money remain salary, dividends, legitimate employee benefits, and reimbursement of genuine business expenses. These methods are transparent to the CRA and are part of normal tax reporting. On the other hand, personal withdrawals, personal use of corporate assets, buying personal property through the corporation, or improperly structured shareholder loans can all create tax risks and may result in additional taxable income. When reviewing any corporate transaction, always ask one simple question: who benefited personally from this transaction? If the answer is the shareholder instead of the corporation, there is a strong possibility that the CRA will apply the shareholder benefit rules. This single question is one of the most valuable tools a tax preparer can use to identify potential tax issues before they become costly reassessments. Corporations are often taxed at a lower rate than individuals, which allows them to accumulate significant amounts of after-tax cash and other assets. Naturally, many business owners want access to this money without immediately paying personal tax. However, this is exactly why the shareholder benefit rules exist. The Canada Revenue Agency wants to ensure that corporate funds are not used as a tax-free source of personal wealth. If shareholders could freely borrow money, transfer assets to family members, or use corporate property for personal purposes without consequences, they could avoid paying the personal taxes that normally apply. Because of this, the CRA closely examines transactions between corporations and their shareholders, especially when they involve related parties such as spouses, children, or other family members. These are known as non-arm's length transactions, and they receive much greater scrutiny because the parties may not be dealing at fair market value. A common red flag is selling a corporate asset for much less than its fair market value. For example, if a property worth $1.2 million is sold to a family member for just $1, the CRA will generally ignore the actual selling price and reassess the transaction using the property's fair market value. This may result in shareholder benefits, capital gains, and additional tax liabilities. Other common warning signs include loans that are not properly repaid, free use of corporate property, personal use of company assets, and transactions involving family members at discounted prices. Whenever you review a transaction between a corporation and its shareholder, ask one simple question: was the shareholder receiving a personal benefit? If the answer is yes, there is a strong possibility that the shareholder benefit rules apply. This single question is one of the most effective ways to identify potential tax issues before they become expensive CRA reassessments.